Have you ever been in the situation where we're in a nice bullish uptrend and we decide to get in on this uptrend and buy into this nice beautiful uptrend only to have the markets reverse on us so fast that if we did not have a stop loss, that just turned a good day into a terrible day? That's what today's YouTube video is about, guys. Today we're going to get into some Elliott wave principles. Now, not only will Elliott wave just give us an idea of where we are within the market and help us time those entries just a little bit better, Elliott wave will also give us deep insight into the nature of the movement of the market. We know that there is a general master cycle where markets enter periods of accumulation, markups, distributions, markdowns. Now, what Elliott wave will do, guys, Elliott wave will tell us where within the cycle we are. Now, just like our example in the beginning, we don't want to be buying. Yes, we're in a beautiful uptrend, but we definitely don't want to be buying at the end of this uptrend. Now, let's get into some Elliott wave principle, guys. We're going to start off with the Elliott wave theory. Now, guys, before we get into the actual meat of today's video, if it's your first time on the channel, definitely do subscribe because we do come out with content like this every single week, guys. And we're only touching on the beginning of the Elliott wave theory. This is just an introduction. We are going to have follow-up videos going much deeper into this theory because it's so extensive and such a beautiful theory to look into. Now let's get into it, guys. So we're going to get into the basic Elliott wave principle. Now, before we start, we have to give some credit to Ralph Nelson Elliott, which is obviously the guy who came up and discovered this amazing principle. Now, Elliott concluded that the movement of any stock market could basically be predicted by observing and identifying repetitive pattern of waves. So what he was basically saying is that every market, in a sense, has waves, and all you could do is look at the waves that we see occurring within the market, and you will be able to predict future waves that we might see within the market. That's a basic Elliott wave principle, and we thank him for thinking that much. Now, in the Elliott wave principle, guys, we only are going to go over two things in this video, guys. We're going to go over what a motive wave is and what a corrective wave is. Now, as simple as those two things sound, you guys know that I always further simplify things, and I give you guys much more than you expected to get in one video. So definitely do stay tuned, guys. It's going to be so meaty and so informative. Now let's get started, guys. So with the motive wave, guys, our motive wave is our impulsive wave. Now within this motive wave, what we will notice is that we do have 5 different waves within our motive wave. So we have wave 1 over there, we have wave 2 over there, we have wave 3 over here, we have wave 4 over there, we have wave 5 to cap things off. Now this is one complete impulsive wave, and we can see that within this impulsive wave we have 5 different legs. Now that's the basic Elliott wave principle. Just speaks about us having these impulsive phases within the market followed by corrective phases within the market. Now we spoke about that in our previous videos, guys, that grandmaster cycle, that markets are only in one of 4 phases: an accumulation, a markup, a distribution, or a markdown. Now what Elliott wave is giving us is Elliott wave is giving us context as to when we are in a markup period, when prices are impulsing to the next key area of value. Now Elliott wave, what Elliott wave is doing is Elliott wave is giving us some context as to where we are within the market. After we've seen that first wave, after we've seen that third wave, what do we expect? We expect that that corrective structure, giving us our 4th wave, and then giving us one more opportunity to get in on an impulse on that 5th wave. That's what Elliott wave is doing, guys. We are getting context as to where we are within the market so that we can approach our trading differently. Under no circumstances, guys, is Elliott wave going to be a reason for us to be executing positions or managing our trade. No, we already have systems, we already have these routines that we have as traders. all Elliott Wave is going to do for us today is Elliott Wave is going to gift us with understanding where we are within the market cycles and how we should be approaching being at that particular spot. So let's get into our corrective wave, guys. So now we spoke about our impulsive wave. We said that our impulsive wave, guys, consists of 5 legs to the upside, or it can be to the downside. Regardless, doesn't really matter whether we're impulsing up or down. And our corrective wave, on the other hand, only has 3 legs. So after we've seen our 5 wave impulsive leg to the upside, we then obviously expect to see our corrective structure, which is only 3 legs to the downside. Our A leg, our B leg, which is obviously the correction of this larger corrective structure, and then our continuation, which is our C leg. So within this corrective structure, we have our impulse, we have our continuation, and we have our impulsive move away, violating some structure over there. So now that we've gotten into that, guys, we understand what our motive wave is. Our motive wave is our impulsive phase, and our motive wave consists of our 5 legs as well as our corrective phase, which consists of 3 legs. Now we need to understand that both of these obviously occur on different time frames. If you guys have not watched our video on time frame thinking, please go and watch that video, because that video will expand your mind, will expand your understanding. Now, part of my outlook with time frame thinking is from exploring the depths of our Elliott wave principle. Now, guys, we spoke about that Elliott wave principle can be used for long-term and short-term outlooks. So we understand that Elliott wave does and is a product, or can be, I guess, seen and viewed on and understood on different time frames. We have, for example, might be able to see maybe this on a daily chart. Maybe we're looking at this nice move to the upside on a daily chart. We see all of our nice 5 impulsive phases. But what we need to understand is that Elliott wave is built upon cycles, guys. There are different cycles that happen on different time scales, and as much as we are looking at this nice impulsive wave on our daily chart, what's happening is that on a, for example, hourly chart, we have one impulsive phase that has its own set of waves. This corrective phase has its own set of waves. This impulsive phase has its own set of waves. This next corrective structure has its own set of waves. And this last impulsive phase has its own set of waves. So now we understand, guys, that there are cycles to this. We're not going to get into the cycles, because the point of today's video is for us to be able to grasp and understand exactly where we are within the markets, so that we can be able to trade, allow ourselves to trade these beautiful impulsive phases. Understanding where we are. Okay, we're in a corrective structure. Next, we're expecting this impulsive phase. We want to be able to make as much as we can, get the best risk to reward ratio, and obviously the best probabilities. And Elliott wave is just one of those tools that can help us get a further insight as to where we are. Now, with Elliott wave, guys, there are, I guess, I think 8, or let's just say 9. I think there's 9 cycles, but we'll just go through them. So there's the biggest cycle, which is called the grand cycle. So the grand super cycle is obviously a cycle that happens on those monthly, those 3-month charts. So on a bigger scale, on a 3-month perspective, on a monthly perspective, there are, or there is, you will find Elliott wave, whether we're in an impulsive phase, or maybe we're in that beautiful corrective structure. There is going to be Elliott wave on that big time frame, guys. It's called a grand super cycle. Now below that, there's just a normal super cycle, and below that we have just a normal cycle, and maybe you'll probably find your cycles on your daily time frames and the like. Then you guys have your primary cycle, which you find even smaller than that. We have our intermediate cycle, we have our minor cycle, we have our minute cycle, we have our minute cycle, and a super minute cycle. So guys, this just shows you that everything in the market is absolutely fractal, and just like a nice vegetable, I don't know if you guys have looked at broccoli, but just if you look at broccoli looks like one big tree. But if you separate one of those leaves on the broccoli, you'll see the exact same thing as this whole big piece of a tree. So just like the broccoli is fractal. You can take off one leaf of broccoli and still see a complete, nice, beautiful tree with its own branches, just the same way the big broccoli stalk it looks exactly like the smaller pieces. Exactly the same thing with the market, guys. The market is absolutely fractal. What we see on those bigger time frames, we see the exact same thing on those smaller time frames. Now, guys, that we understand our cycles, now that we understand our Elliott wave, our different waves within our impulsive phase and within our corrective phase, now we're going to put all of that information together. So guys, we have an example here of what we've been talking about. So this is, we'll just say, is one cycle. What we'll say that one full cycle includes an impulsive phase and a corrective phase. Now, we spoke about that within this impulsive phase, we see further impulsive phases there, corrective phases here, impulsive phases there, corrective phases here, impulsive phases there, and then obviously in our larger corrective structure we have our impulsive phase to the downside, our corrective phase to the upside, and our continuation of our impulsive to the downside again. Now, guys, Elliott wave involves rules, it involves guidelines, and we're going to go over these 7 simple guidelines so that we always understand our Elliott wave principle. Now let's get into number 1, guys. So we know our Elliott wave, our impulsive phase consists of 5 different waves. It will never change, it will never be different. Any impulsive phase in the market should have these 5 waves for us to be able to classify this as our Elliott wave principle. So we'll number them obviously 1, 2, 3, 4, 5. And then our second rule, our second guideline is that wave number 1, wave number 3, and wave number 5 are our impulsive phases. So wave number 1, wave number 3, and wave number 5 are our further smaller impulsive phases. Now, what does that mean for us as traders? Us that trade those chart patterns, those continuation structures, we will now be able to identify where we are. Are we in wave 1? Should we be expecting a corrective structure for that next impulsive phase? That will just give us such an edge of being able to see where we are within the market, being able to time our entries even better than we're timing our entries at this current moment in time. So we'll go on to rule number 3, our third guideline, guys. Wave number 2 and wave number 4 are always corrective structures. So we've discussed wave 1, impulsive. Wave number 2 is always a corrective structure. Wave number 3, impulsive. Wave number 4 is always a corrective structure. And then we have that wave number 5, which can end impulsively as well. Now, let's get into our rule number 4, guys. Wave number 2 cannot go lower than wave number 1. So if we zoom into this, we know that this is obviously our wave number 1 over there, and this is our wave number 2. Wave number 2, it can retrace as far as it would like to retrace, but cannot retrace lower than where our wave number 1 has started, guys. So wherever wave number 1 started, wave number 2 cannot terminate lower than our starting point of wave number 1. Now that we've got that down, we'll go on to rule number 5. Now, wave number 3 cannot ever be the shortest impulsive leg. Now, we've already discussed that we have 3 impulsive legs. Obviously, wave number 1, wave number 3, and wave number 5 are all impulsive phases. So we can't have, under no circumstances, can wave number 3 be the shortest impulsive phase of these 3 impulsive phases. So we need to see wave number 2 being either the longest, most impulsive phase, or wave number 5 being the longest or most impulsive phase, but never can wave number 2 be the shortest. One of these waves has to be the longest, either wave number 2 or wave number 5 or wave number 1, but wave number 3 cannot be the shortest. And that is a golden rule, guys. Let's go on to rule number 6. Wave number 4 cannot overlap price with wave number 1. What does that mean, guys? We have wave number 1. Wherever wave number 1 stops, wave number 4, which is obviously our corrective structure over here, wave number 4, guys, cannot overlap price with wave number 1. That means that wave number 4 and wave number 1 will never ever touch. See where our wave number 4 starts? It does not touch where wave number 1 ends. There will always be a gap in between where wave number 1 terminates and where wave number 4 begins or retraces from. So there will always be a gap. Wave number 1 and wave number 4 will never ever overlap in price. We'll get on to our 7th and final rule, guys, is wave 5 ends with a loss of momentum. So more often than not, guys, we'll find out that our wave 5 will always either end in some kind of an ending diagonal where we see prices maybe ending with a rising wedge or something of that nature. We'll either have a reversal structure like a double top or a head and shoulders, or whatever the case is, guys. Wave number 5 will always and should always terminate and should always give us that loss of momentum at the end. Guys, now that we have these 7 decisive rules and we understand our impulsive phases, we understand our corrective phases, now it would be so much, or rather we'd have so much more context, and you guys would understand that as much as we've been doing our technical analysis and understanding our CHF JPY and all of that stuff with no technical, or rather let's just say with no Elliott wave whatsoever, we still anticipated all of this selling momentum. That's just to say we've been using structure, but we've seen that loss of momentum. This is our 5th wave on this higher time frame structure. We've seen that loss of momentum, and we know that our last waves end with that loss of momentum. Nonetheless, as much as we've just been trading our chart structures, our looking for impulsive legs, looking for those corrective structures, now that we understand our Elliott wave, what does that tell us about where we are right now? We've seen our A. We need to see our B corrective structure leading into our C impulsive wave to complete our corrective structure of Elliott wave. After our 5 waves to the upside, we expect our 3 waves to the downside, giving us that beautiful corrective structure. And that's exactly what we're looking for on CHF JPY, looking for those potential buy opportunities short term, but understanding that long term our selling momentum is going to come in. Now, as much as we didn't use Elliott wave, I hope you guys can see how purely fundamental and important Elliott wave is in understanding exactly where we are within the markets, guys. Now, in our future videos, guys, we're going to follow up with things like leading diagonals, how our wave 1s begin. We'll also go into ending diagonals, how our wave 5s end. We'll also talk about, guys, the 5 corrective structures that exist within our Elliott wave theory, so that we understand properly our waves 2, oh, wrong tool, guys, so that we properly understand our waves 2. How can our wave 2 form? How can we be able to capitalize on this corrective structure, being able to buy this next impulsive move? How can we capitalize on wave number 4, being able to buy the next impulsive wave number 5? How can we capitalize on this wave number B of our corrective structure to capitalize on that last impulse